For your analytical shortcut, taking these, well, let's face it, complex corporate financial reports
Definitely complex.
and pulling out the really important stuff, the surprises, the key knowledge for you, the curious learner.
And today, we are diving deep into a really significant one, especially if you follow global industry or the Turkish market.
Which one is it?
It's the third quarter consolidated financials for Türkiye Şişe ve Cam Fabrikaları AÇ. We'll just call them Şişe Cam, much easier.
Good call. Şişkam.
We're looking at their reports covering January 1st through September 30th, 2025, the consolidated statements.
Right. And crucially, we're not just, reading numbers aloud here. These figures are presented under a specific standard, aren't they?
Yes, exactly. Turkish Accounting Standard, TMS 29.
And for listeners who might not know, TMS 29 means what exactly?
It means hyperinflation accounting. This is absolutely fundamental context.
Because Turkey's economy has been designated as hyperinflationary.
Correct. So every single number we talk about today, revenue, assets, costs, everything is inflation adjusted.
Okay.
They reflect the purchasing power of the Turkish lira as of September 30th, 2025.
So if you didn't do that adjustment, comparing this year to last year would be, well, pointless.
Completely meaningless. The numbers would just be bloated by inflation, by the depreciation of the lira. It wouldn't tell you anything about real performance.
So this adjustment, it kind of levels the playing field for comparison.
It does, but it also adds complexity, no doubt.
Yeah, I can imagine. Analyzing result adjusted this way, it means even calculating basic costs and revenues is intellectually challenging.
It is. We're trying to strip out all that monetary noise, that volatility, to see the real constant currency performance.
It's really the only way to know if the company is actually growing in real terms, right?
Exactly. And that's our mission today. We want to dive deep into these reports so that you, whether you're an individual investor or just watching the market, can get a clear, thorough understanding of Şişkem's health.
We're aiming to cut through the jargon, focus on the numbers that really tell the story.
Turning, hundreds of pages of dense financial data into a clear narrative. What's working? What are the challenges?
Operational success versus those financial headwinds seems to be a theme emerging already.
It does.
And just before we really get into unpacking this Turkish industrial giant, a quick reminder. If you find this analysis valuable, please do like, subscribe, share this deep dive.
Yeah, your support really helps us produce more of these specialized analyses for you.
Okay, let's start with the basics then. Who actually is Şişkam, and what do they really do? Because it's more than just glass, right?
Oh, much, much more than just glass. People might know the name Pashabaste, the glassware brand.
Right, that's the familiar one.
But that's just one piece of a much larger puzzle. Şişkam was founded way back in 1936.
Wow, long history.
By Türkiye Bankası Eşik, actually.
Yeah.
They're headquartered in Tuzla, near Istanbul, and they're a big player on the Borsa Istanbul, ticker SISI. But calling it just a glass manufacturer really misses the scale.
Yeah.
It's a massive, vertically integrated conglomerate. Think of it as an industrial ecosystem.
An ecosystem designed for self-sufficiency, maybe. Resilience.
Exactly. Resilience is built right into its structure. The footnotes, if you dig in, show the sheer size of this thing.
How big are we talking?
54 subsidiaries,
54.
plus one joint venture, 4 associates, and 1 joint operation. It's a huge corporate family spread across different countries, different currencies.
That's incredibly complex to manage.
It is. And that structure supports 7 main business groups. Understanding these is key to seeing how they achieve stability.
Okay, what are the 7 groups?
All right. First, architectural glass. That's flat glass, mostly for construction, buildings, cars.
Makes sense.
Then industrial glass. Think specialized stuff. Fiberglass, components for appliances, white goods.
Right.
Third is glassware. It's your posh-bosh, the consumer side. Gives them stable income. Fourth, glass packaging. Bottles, jars, container glass. Really essential for food, drinks.
Very stable demand there too, usually.
Then number 5 is energy. This is critical. They have internal capacity, giving them some control over a huge input cost.
Ah, smart. Vertical integration.
Exactly. Number 6 is chemicals, mainly soda ash and chromium chemicals. These are essential raw materials for making glass.
So they supply themselves.
To a large extent, yes. And finally, number 7 is other. This includes things like their internal recycling operations, mining Tamis Madenslik, and various trading activities.
So that vertical integration, having their own mining, their own energy, That must give them a real edge, especially when supply chains get tight or energy prices spike, like we've seen.
It's a massive structural advantage. It means they could absorb some of those shocks internally. It transforms them from just a manufacturer into more of a fundamental materials supplier. Hashtag tagged 1.2 global reach and geographical breakdown.
And this structure isn't just in Turkey, right? They're global.
Absolutely. A true multinational. Significant operations, production, sales, spanning Italy, Bulgaria, India, Egypt, Russia, and importantly, the U.S.
Let's talk about the U.S. for a second. That's mainly in the chemicals group.
Yes, and it's not just about selling products there. It's about controlling strategic resources.
Like natural soda ash.
Exactly. Through companies like Syscam Chemicals Resources LLC and Pacific Soda LLC. This focus on natural soda is a big, long-term strategic play to secure those critical raw materials.
Interesting. And can we see this global spread in the sales number?
Yes, the 9-month 2025 net sales breakdown shows it clearly. They're definitely not just a domestic Turkish company anymore.
So where does the revenue come from?
Well, Turkey is still the biggest single chunk, about 94.5 billion Turkish lira in net sales for the first 9 months.
Okay, still dominant.
But Europe is vital. That brought in 31.6 billion lira.
Significant.
And the Americas are growing 16.0 billion lira from there.
What about other regions?
Well, there's also a notable 17.1 billion lira generated from a cluster including Russia, Ukraine, and Georgia.
17 billion lira. That's substantial revenue, but that region, that comes with a lot of geopolitical risk right now, doesn't it?
Absolutely. Huge risk. The reports even mention specific operations in Ukraine, like Marefa Glass Company, and in Russia, Traki Glass Rus AO.
So they have boots on the ground in very volatile areas.
They do. And that revenue stream, while significant, must carry a massive risk premium. It ties directly into the currency and hedging risks we'll discuss later.
Right. Speaking of strategy and risk, you mentioned Pacific Soda in the U.S. There was some recent M&A activity there, footnote 3, I think.
Yes, good catch. In December 2024, Shishikem actually increased its stake in Pacific Soda LLC to 100%.
Owning it outright now?
Exactly. And that means they shifted from proportional consolidation to full consolidation in their accounting.
What does that shift signify strategically?
It signals they're taking full financial responsibility, obviously. But more importantly, it shows a clear strategic doubling down on the U.S. market and those natural soda resources.
Like a big vote of confidence in securing that long-term raw material supply, maybe hedging against future shortages or locking in costs away from the Turkish lira's volatility?
That's exactly how I read it. It suggests they see the chemicals segment, especially in the U.S., as a key pillar for future stability and growth, not just some side business. Hashtag 1.3 corporate structure and human capital.
Okay, let's shift gears slightly to the corporate side. Ownership and governance. Who's ultimately in control?
Well, the founding institution, Türkiye Bankası O.A., still maintains control. They hold a 52.58% direct stake as of September 30, 2025.
That provides a degree of stability, I suppose? Institutional backing?
It does, a firm footing, especially when navigating economic turbulence.
Now, for individual investors, stability is one thing, but transparency is key, especially with these huge, complex conglomerates. How do they score on governance?
Actually, very well. They have a high SOC corporate governance rating. It was 96.46 as of December 2024. That's really top tier.
96.46. That's impressive for such a sprawling company.
It is. The breakdown shows excellent performance on things like shareholder rights, disclosure, transparency. A score like that generally suggests you can rely on the reporting and internal controls.
Which is extra important when dealing with hyperinflation accounting like TMS 29.
Absolutely critical.
Okay, what about the people? Human capital, is that changing?
Yes, and quite significantly. The reports show a noticeable reduction in personnel.
A reduction? How much?
Total employees dropped to 22,495 as of September 2025.
Okay.
That's down from 23,805 at the end of 2024, and even more from 24,950 back in September 2024.
So doing the math, that's a reduction of about 3,310 people since the end of last year.
Correct. Almost 2,500 fewer people than a year prior.
Why the decrease?
Yeah,
Efficiency gains? Delay?
That seems the most likely explanation, especially given the operational performance we're about to see. In heavy industry like this, modernization and automation are huge drivers of margin.
So fewer people, but maybe higher productivity from those remaining.
That would be the inference, yes. successful technological integration, optimizing labor costs across their global facilities.
But hang on, could it also be partly due to, say, divestitures or maybe scaling back in some of those higher risk regions like Russia or Ukraine, or maybe closing older plants?
That's a fair question. The reports don't break down where the cuts happen geographically.
Right.
So while efficiency gains seem probable given the profit surge, it could also reflect some prudent contraction or rationalization in certain areas.
It's an important distinction for an investor, isn't it? Efficiency is bullish, contraction maybe less so, depending on why.
It is. Though the simultaneous jump in profitability makes the efficiency argument stronger, the risk of trimming operations in volatile regions definitely remains a factor to keep in mind.
So, net result. Fewer employees, but driving higher margins. Interesting. One quick note, you mentioned the high governance score, but the summary reports don't give everything, right? Like specific details on executive pay or female board representation.
That's correct. Those granular details aren't in these summary financials. We have the high overall score, which implies good practices, but not that specific level of detail here.
Okay, so we've got the foundation. A massive, complex, vertically integrated, globally expanding, well-governed, but also right-sizing company.
That sums it up pretty well.
The big question now is, does this structure actually make money? Let's get into the operations in part 2.
All right, let's transition to the core profit and loss statement. And remember, every number here is inflation adjusted using TMS 29.
Got it. Inflation adjusted. So comparing the first 9 months of 2025 to the same period in 2024, what jumps out immediately?
Well, the first thing you notice, and it's a bit of a shock initially, is the top line, the revenue.
Okay.
Hasalat, or net sales, actually dropped, quite substantially in fact, by about 10.6% in real terms.
A drop. How much are we talking in lira?
It went from 181.7 billion lira in 9M 2024 down to 162.3 billion lira in 9M 2025.
Wow, that's nearly a 20 billion lira decline in real sales. That feels significant. What does that suggest? A tough market.
You definitely suggest a challenging demand environment, maybe a slowdown in Europe or cooling construction markets globally, or perhaps they had to lower real prices to keep volumes up.
Okay, so revenue down. That sets the stage for the next line, gross profit, which must be down too, right?
And here's where it gets really interesting. No.
No.
Despite that 10.6% drop in real sales, the brute car, the gross profit, actually increased.
Increase? How is that possible? Sales down, profit up.
It rose robustly.
Yeah.
To 45.1 billion lira in 9M 2025, up from 41.6 billion lira the previous year.
Okay, my head's spinning a bit. Revenue drops by almost 20 billion, but gross profit rises by about 3.5 billion. How does that work financially?
The answer lies in the line item between sales and gross profit, the cost of goods sold. Satislar and Malietti.
Okay, QGS, what happened there?
It plummeted, fell dramatically from 140.1 billion lira in 9M 2024 down to 117.2 billion lira in 9M 2025.
So they slashed their real input costs by, what is that, nearly 23 billion lira.
Exactly. Phenomenal cost control. And that directly translates into a much stronger gross margin ratio.
Right. What did the margin percentage do?
It improved sharply. Went from roughly 22.9% in the first 9 months of 2024 to a much healthier 27.8% in the same period of 2025.
That's a huge jump, almost 5 percentage points. So this massive reduction in the real cost of goods sold is really the story of their operational performance here.
It is absolutely the defining operational narrative for this period. It points to success on multiple fronts.
Such as?
Well, first, those efficiency gains. We talked about the personnel reductions, automation, modernization paying off.
Okay.
Second, they likely benefited from lower real prices for some key inputs, maybe energy, maybe certain chemical commodities. That vertical integration probably helped shield them there.
Right, controlling our own supply.
And third, maybe the full consolidation of those U.S. soda ash operations is starting to lock in raw material supply at better real costs, insulating them somewhat from lira-based input inflation.
So, bottom line on this part. Even though the market bought less, what Shisha Camp did sell, they produced far, far more cheaply and efficiently in real terms.
Precisely. It's a real testament to operational discipline, especially under intense inflationary pressure.
Okay, so that strengthened gross profit. Did it float in the income statement? Let's look at FFO or EBITDA.
Yes, it flowed through powerfully. FF, which is earnings before interest, taxes, depreciation, and amortization.
A good proxy for cash generation from the core business before financing costs kick in.
Exactly. And FF surged. It increased robustly by 22.4%.
22%. Nice.
Reaching 18.24 billion lira in 9M 2025, up from 14.91 billion lira in the same period last year.
So that confirms the underlying business was just throwing off cash much more effectively this period. Reinforces that gross margin story.
It does. But perhaps the most striking indicator of management success, for me, is the turnaround in Isas Valiet Kari.
Core operating profit. Why is that one so significant?
Because this is profit after accounting for all those general, administrative, and marketing expenses, the corporate overhead.
Right, the SG&A costs. So it reflects not just production efficiency, but overall corporate discipline.
Exactly. And the change here is dramatic. Stark, really.
How dramatic?
In the first 9 months of 2024, Shishcam actually posted a small core operating loss of about 275 million lira.
A loss.
For the first 9 months of 2025, they swung that into a decisive profit of 4.53 billion lira.
Wow. From a 275 million loss to a 4.5 billion profit. That's a swing of nearly 5 billion lira.
It is, and that's why it's more profound in a way than just the gross margin improvement. Because improving gross margin means you produce cheaper. But turning an operating loss into a 4.5 billion lira profit after covering all the global admin costs, the marketing, the R&D, that shows the cost-cutting and efficiency wasn't just on the factory floor.
It was across the whole corporate structure.
Yes, they successfully managed those massive operating expenses to deliver a clear profit from core activities. It proves the company is leveraging its global scale effectively.
That's a really significant achievement for the management team. Now, can we pinpoint where in the business this strength came from? Hashtag 2.3 segmental performance and investment focus.
Yes, the segment performance data that's in Dipnot 4 gives us that granularity. It breaks down FAVK by business group.
Okay, so which segment was the star performer driving this big operational improvement?
The undisputed champion by far was architectural glass, Mamari Kamlar.
The flat glass for buildings and cars.
That's the one. Its FAVA contribution was 9.17 billion lira in 9M 2025.
Okay, 9.17 billion. How does that compare to last year?
It nearly doubled. It was 5.04 billion lira in 9M 2024.
Doubled. That's incredible growth and profitability for that segment. What could be driving that? Strong construction markets.
It suggests very strong, or at least very price-resilient, demand in their key markets, probably Europe and Turkey. Maybe post-pandemic construction, big infrastructure projects where Shishcam's scale gives them pricing power.
And clearly they managed costs incredibly well in that segment, too.
Absolutely. Okay, where else did we see strength?
What about glass packaging? Bottles and jars?
Another reliable powerhouse. Glass packaging, Cam Emballage, contributed 6.17 billion lira to FAV. Up significantly from 3.40 billion lira last year.
That confirms that sort of stable, almost recession-resistant performance you expect from food and beverage packaging? Solid.
Very solid. Now, for a potential area of concern, or at least less strength, chemicals. Give me Solar.
Ah, the segment where they're making big strategic bets, like in the U.S. with soda ash. How did it do?
The FAV contribution dipped here. It generated 4.98 billion lira.
Which is down from?
Down quite a bit from 7.94 billion lira in 9M 2024.
A significant drop. What does that tell us?
Well, it suggests the chemical segment wasn't immune to global commodity price pressures. Maybe prices normalized after the crazy spikes we saw in 2022 and early 2023.
Right, these are cyclical materials.
Exactly. So the dip confirms market pressure, but it also highlights why that U.S. soda ash strategy is so important long-term. It's a defense against exactly this kind of short-term price volatility.
Okay, makes sense. And the last main segment, industrial glass.
Industrial glass, industrial Kamlar. This covers things like automotive glass components, glass for appliances.
How did it fare?
This one showed the most dramatic turnaround, actually, from being in the red.
Really?
In 9M 2024, it posted a FAVOK loss of 1.18 billion lira.
Ouch!
For 9M 2025, it swung to a positive FAVO of 307 million lira.
So from a billion-plus loss to a profit. Still small, but a huge improvement. What does that signal?
It suggests demand in those sectors, like automotive and white goods, while maybe still tight, is recovering somewhat.
Great.
And crucially, the company has gotten cost under control, moving from loss-making back to profitability in that segment.
So overall, the segment picture shows diversification is working, architectural glass is booming, packaging is solid, chemicals felt some pressure, and industrial is turning around. Efficiency seems key across the board.
That's a good summary. Hashtag tag 2.4, the net profit paradox.
Okay, this all sounds operationally fantastic. FAVUSHE up 22%. Core operating profit swinging nearly 5 billion into the black.
Yeah, really strong.
So then, Why did the bottom line, the net period profit attributable to the main shareholders, actually drop?
The paradox.
It fell from 8.15 billion lira in 9M 2024 down to 5.74 billion lira in 9M 2025. How do strong operations lead to lower net profit? This is the bit investors need to understand.
And this is probably the single most important takeaway from this whole report.
Okay.
It shows that fantastic operational execution can still get hammered by a tough financial environment. The answer lies completely outside the core operations. We have to look at financing costs and taxes.
Right, the external factors. So what were the main drags?
The biggest one is financing expenses. They are substantial and they grew. 35.6 billion lira in financing expenses for 9M 2025.
35 billion. Wow, compared to last year.
Up from 33.3 billion lira in 9M 2024.
So higher financing costs, what? Rising interest rates.
Exactly. It's a direct hit from the high interest rate environment globally.
Plus, remember, Shuscam's debt is heavily weighted towards foreign currency.
US dollars, euros?
Right, which makes those borrowing costs volatile and expensive to service, especially when the lira is fluctuating. They're simply paying a lot more interest on their debt no matter how efficiently they make glass.
So a high leverage company facing high interest rates and FX volatility, that makes sense as a major drag. What about the tax line?
The tax line was the other big hit to the bottom line, a really significant swing.
How so?
In the first 9 months of 2025, the company recorded a tax expense of 3.26 billion lira.
Okay, a cost.
But compare that to 9M to 2024. In that period, they actually had a net tax income or gain of 963 million lira.
Whoa, so it swung from a nearly 1 billion lira tax gain last year to a 3.26 billion lira tax expense this year. Precisely. That's a negative swing of over 4.2 billion lira just on the tax line alone.
That's huge. So basically, the fantastic improvement in operating profit got eaten up by higher interest payments and this massive negative swing in taxes.
That's exactly it. The lower net profit, despite the brilliant underlying operational performance, directly reflects these external pressures. High leverage costs and specific charges like taxes hitting hard in the current period.
It really underscores that the company's biggest challenge right now seems to be managing its financial structure and navigating market volatility, not actually running the core business.
That's the crux of it. Operational strength is there, but the financial environment is tough.
Okay, let's pivot to the balance sheet then. Given those big financing costs and the investments they're making, how does their cash position look? How liquid are they?
Well, the balance sheet looking at Dipnot 5 shows a pretty significant decrease in their immediate cash and cash equivalents.
A decrease. How much did it drop?
It fell to 42.35 billion lira at the end of September 2025.
Down from
67.30 billion lira at the end of December 2024.
That's a drop of 25 billion lira in cash in just 9 months. That sounds like a big drawdown. Should investors be worried? Where did that cash go?
It was definitely deployed, not just, burned, but it's still managed carefully. The footnote explains that a big chunk of the remaining cash, about 28.9 billion lira, isn't just sitting there.
Okay.
It's held in short-term time deposits. So it's cash being actively managed to earn some yield while they presumably wait to use it for capital expenditures or upcoming debt payments.
Actively managed and earning yield. Given the Turkish financial environment, what kind of yield are we talking about?
It's pretty eye-opening. The deposits are spread across different currencies: euro, US dollar, Turkish lira, even Russian ruble.
Diversification.
Yes. But the Turkish lira deposits, some were earning interest rates as high as 48.5%.
48.5% on short-term deposits.
Yep. It's almost surreal from a Western market perspective, but it reflects the extreme conditions.
It shows the kind of financial engineering needed just to try and maintain purchasing power in that market.
Exactly. And it also shows they're trying hard to generate interest income to help offset those massive interest expenses they're paying on their debt. The currency diversification is their shield against any single currency collapsing.
Yeah.
Hashtag, tag 3.2 debt structure and net debt.
Okay, let's talk about that debt then. Dipnot 7. This seems like the core financial challenge. What's the overall picture?
Well, the headline number for total financial borrowings actually decreased slightly. It went down to 159.08 billion lira at the end of September 25 from 164.01 billion at the end of 24.
A slight decrease. That sounds okay.
On the surface, maybe. But the real story, the potential red flag, is hidden in the breakdown of that debt, specifically the split between short-term and long-term.
Ah, the maturity profile. What's happening there?
There's been a massive, and I mean massive, increase in the short-term portion of long-term debt.
Okay, break that down. That's long-term debt that's now coming due within the next 12 months.
Exactly. And that figure has exploded. It went from 26.46 billion lira at the end of 2024
Right.
to 55.02 billion lira by the end of September 2025.
55 billion. It more than doubled.
Yes, more than doubled in just 9 months.
That sounds like the single biggest financial risk factor right now. 55 billion lira that needs to be paid back or, more likely, refinanced within the next year.
That's absolutely correct. It creates significant refinancing risk, especially in a tight, high-interest rate environment.
So total short-term debt must be much higher now then.
It is. Total short-term financial borrowings are now 70.15 billion lira. This big jump signals a much higher immediate liquidity need.
Now, is this necessarily bad management? Or could it be strategic? Like, are they deliberately letting some expensive debt mature, hoping to refinance it under better terms later, even if it means taking on near-term risk?
That's the crucial question. With a company this size and sophistication, it's rarely just bad management. It's more likely a managed risk.
Oh.
Remember, their debt is heavily concentrated in US dollars, about 91.6 billion lira equivalent, and euros around 36.5 billion lira.
Right.
It's quite possible they allowed some existing foreign currency loans, maybe ones they felt were too expensive or poorly hedged, to roll into the current portion. They might be waiting for a calmer macroeconomic climate to execute a large-scale refinancing.
But regardless of the strategy, the execution risk in the next 12 months is still very high.
Very high. They have to successfully roll over or replace that 55 billion lira coming due.
And with the cash balance lower than before, the net debt figure must have gone up.
It did, significantly. Net debt, which is total borrowings minus cash, increased sharply.
How much?
It went from 96.7 billion lira at the end of 2024 up to 116.7 billion lira by September 2025.
That's a 20 billion lira increase in net leverage. Where did that come from? Mostly deploying cash for investments.
Exactly. That cash drawdown we saw earlier, mainly going into CapEx, means less liquid reserves available to offset the gross debt number.
So investors are looking at a company with huge exposure to currency swings, a wide range of interest rates on its debt from low single digits on euro debt to over 30% on lira debt, and a big chunk of that debt needing refinancing soon.
That's the picture. The scale of the FX-exposed debt alone means any currency volatility hits their financial metrics hard and fast. Hashtag 3.3, the power of operating cash flow, OCF.
Okay, so if the debt structure is this heavyweight, what's keeping them afloat? You mentioned strong operations earlier. Does that translate into cash flow?
It absolutely does, and this is the crucial counterbalance. The operational success we saw in Part 2 gets converted into financial resilience right here in the cash flow from operations, or CFO.
OCF. This is the hero of the story, maybe.
It's definitely playing a heroic role right now. The performance here is genuinely outstanding and validates that whole margin improvement story.
So how good was the OCF?
Cash flow from operations reached 28.98 billion lira in the first 9 months of 2025.
Okay, nearly 29 billion. How does that compare to last year?
It's an incredible increase, over 73% higher than the 16.68 billion lira they generated in the same period of 2024.
73%. A surge like that in cash generated just from running the business. It's vital.
It's absolutely key. That's the cash they need to service that huge debt pile and continue funding all those growth projects without constantly having to borrow more or issue equity.
It shows the quality of their sales, their working capital management. It's real cash.
Exactly. It confirms the underlying health of the core business activities.
And we know where a lot of that cash generated went, right? We just talked about the drop in the cash balance. It went into investments.
Straight into investments. The net cash outflow from investing activities was huge. 23.33 billion lira in the first 9 months.
And what was the bulk of that investment spending?
Primarily, it was high capital expenditures, CapEx, for tangible and intangible assets. That accounted for 22.95 billion lira.
So buying machinery, upgrading plants, maybe software.
Exactly. Plus, they also spent about 7.1 billion lira on acquiring shares in subsidiaries. Dipnot 9 mentions this relates largely to wrapping up the payments for that U.S. Pacific Soda acquisition we discussed earlier.
Right. So spending 23 billion lira on investing activities clearly shows they're aggressively reinvesting for the future modernization, expansion, controlling resources.
It signals management's confidence in the long term, definitely, but it also explains why the cash pile shrank and net debt went up.
So the investor has to weigh that. Do you trust that this heavy CapEx will generate enough future return to justify taking on this increased near-term financial risk?
That's the central question. So summing up Part 3, operations are generating record cash, which is fantastic. But the financial market pressures and the company's own growth ambitions mean that cash is immediately being put to work managing a complex, FX-heavy debt load and funding massive future projects.
Okay, let's move down the balance sheet to the owner section. Oskanackler, or shareholder equity. This is what's left after all the liabilities. How did that look?
Well, total equity attributable to the main parent company actually decreased slightly. It went from 233.38 billion lira at the end of 2024 down to 229.74 billion lira by September 2025.
A slight decrease? Seems relatively stable on the surface.
Deceptively stable. If you dig into the changes in equity, you uncover the hidden cost of being such a global player. We have to look at other comprehensive income, or OCI.
OCI. Right, this is often where the complex stuff hides. Can you explain what's going on there? You called it financial scar tissue earlier.
Yeah, that's a good way to think about it. The main income statement, the P&L, is like a snapshot of health over the recent period. OCI is more like the accumulated impact of long-term financial stresses,
Stresses
like gains or losses from translating the financial statements of all those foreign subsidiaries back into Turkish lira, or gains and losses on financial hedges they put in place. It doesn't hit the main P&L immediately each quarter, but it accumulates directly within equity. It's like a running tally of the financial pain or sometimes gain from global operations.
And in Shuscom's case, it's mostly pain accumulating.
Oh yeah, massive accumulated pain. If you look at the line item, accumulated other comprehensive income or loss, reclassifiable to profit or losses,
Okay.
the total accumulated loss there has ballooned. It stood at a negative 71.8 billion lira in September 2025.
72 billion lira in accumulated losses sitting in equity. Wow. How much did that increase just in these 9 months?
It increased by about 7.9 billion lira. It was negative 63.9 billion at the end of 2024.
So another nearly 8 billion lira loss accumulated in OCI this period. Where did that come from mainly?
Mostly from foreign currency translation differences, just the mathematical effect of converting assets held in weakening lira terms, and also from losses on cash flow hedges related to their net investments in foreign operations.
So even with sophisticated hedging strategies, which cost money themselves, the sheer scale of their global footprint and the volatility of currencies like the lira, maybe the ruble too, means managing this FX risk creates a gigantic ongoing drag on shareholder equity.
It's the unavoidable financial price tag of being a truly global company operating across so many borders in today's volatile world.
Dipnot 7 even puts a number on part of it, right? Mentioning FX losses related to borrowings classified under OCI.
Yes, it specifically notes 14.1 billion lira worth of FX loss related to financial borrowings was classified under OCI as part of their net investment hedging accounting. It confirms these are complex financial maneuvers designed to mitigate risk, but they still resulted in substantial real losses hitting equity because the currency moves were just too large.
Okay, shifting from those big macro currency impacts to something very specific. There was a major one-off expense mentioned in the footnotes, Dipnot 20, that really hit the Q3 profit hard, wasn't there?
Yes, absolutely critical to understand this one if you're looking at the net profit figure. Şuşecam recorded a provision in Q3
A provision for what?
for a penalty notified by the Turkish Competition Authority, the Rekabet Kurumu.
A competition fine. How large was the provision?
2.37 billion Turkish lira. That's 2,365,993,000 TL, to be precise.
2.4 billion. That's huge. That's almost half of their entire net profit for the 9 months.
Exactly. It's a massive one-off shock that significantly distorts the reported profitability for the period.
Did they explain the number?
Yes, the footnote says the figure includes a 25% discount because they're assuming they'll pay it early. So the actual fine might have been even larger before the discount.
So this is a major non-recurring cost. If this fine hadn't happened, the net income picture would look completely different.
Radically different. It likely would have shown a year-over-year increase in net profit, reflecting that strong operating performance instead of the decrease we actually saw.
What does a big, unexpected fine like this do to investor confidence, especially in a market that can sometimes feel a bit unpredictable regulatory-wise?
You definitely test confidence. You have to ask, was this a genuine compliance lapse, or is it indicative of broader regulatory risks in that market?
Even with that high governance score.
Exactly. The high score suggests good systems. But this fine is proof that even well-run companies can face these sudden, multi-billion lira regulatory hurdles that demand immediate cash. It highlights sovereign and regulatory risk, #tag 4.3 investments, asset sales, and future outlook.
Okay, let's circle back to investments. You mentioned the huge capex outflow. What does that tell us about management's view?
That 23 billion lira capex spend really underscores their confidence in long-term growth and the need for continuous operational upgrades. They're pouring money into Mayan Duran Varlik, Alamlara tangible and intangible fixed assets.
So modernizing production.
Yes, ensuring that cost efficiency we saw in the gross margin isn't just temporary, but sustainable, because they have state-of-the-art facilities. It's a massive bet on future demand justifying the cost.
But they're not just spending, right? They're also managing their existing assets, selling some things.
Correct. Dipnot 9 details a strategic asset sale. They sold some land and buildings in Tuzla, near their HQ,
For how much?
for 2.5 billion lira plus VAT back in August 2025.
Selling off non-core real estate to raise cash. That seems like prudent management, especially when the core business needs so much reinvestment capital.
It does, generating liquidity or helping fund those big growth projects
Yeah.
by monetizing assets that aren't central to operations.
And what about returning cash to shareholders? Dividends? Buybacks?
They did pay a dividend, 2.0 billion lira gross dividend back in May 2025.
Okay, so still committed to shareholder returns.
Yes, but you can see the priorities shifting. The heavy investment cycle and the financial pressures mean growth and debt management are clearly the top focus right now.
How so?
Well, they let their share buyback program expire in September 2025 and didn't immediately announce a new one. That suggests cash flow is being prioritized for capex and internal needs over repurchasing shares at the moment. Hashtag 4.4 SWOT summary implied an investor takeaway.
Okay, let's try and pull all these threads together. If we were to do a quick SWOT analysis, strengths, weaknesses, opportunities, threats based on this Q3 report, what would it look like? And most importantly, what does it mean for you, the listener?
All right, let's try. Strengths, S, are pretty clear. Massive operational scale, that robust global footprint across 7 diverse business groups, and phenomenal operational efficiency.
That 73% jump in operating cash flow, the booming architectural glass segment.
Exactly. The core business engine is running incredibly well. That's the biggest strength.
Okay, weaknesses, W. Where are they vulnerable?
It's almost entirely on the financial side. The complexity leads to high exposure to currency risk, evidenced by that huge accumulated FX loss sitting in equity, 71.8 billion lira.
A massive weight.
And the big one, that sharp spike in the short-term debt maturity profile. That's a major near-term liability, creating significant refinancing risk. Plus, the net debt position has increased.
Got it. Financial structure is the weakness. What about opportunities? Where's the upside?
The opportunities lie in that heavy capex spending. That 23 billion lira investment signals management expects good returns from new capacity or upgrades.
Especially from integrating those U.S. soda ash operations fully.
Yes, that's key. Positioning them for market share gains in places like Europe and the Americas when global demand eventually firms up. The investment today is for growth tomorrow.
And finally, threats. T. What external factors could hurt them?
Global commodity price volatility is always a threat. We saw that slight dip in the chemical segment. High financing costs due to persistent high interest rates will likely continue to suppress the net profit figure.
And the geopolitical risk.
Absolutely. Cannot ignore that. Their substantial operations in the Russia-Ukraine-Georgia region are generating revenue now, but that region remains highly unpredictable and carries significant risk.
Okay, so pulling that SWOT together, what's the core message for an individual investor looking at Shishikams right now?
I think the message is one of duality. It's a split picture.
How so?
On one hand, you're investing in a company with truly world-class operational management. They are masters of efficiency and cost control in a tough environment. They're generating cash flow like never before.
That sounds incredibly bullish, especially if you have a long-term view.
It is. Operationally, the story is very strong.
But the other side of the coin.
The other side is the financial structure and the external environment. If you're holding Shuscam shares, the next 12 months or so are going to be defined just as much by their ability to manage that refinancing risk as by their operational performance.
Watching that short-term debt maturity profile becomes critical. Can they successfully refinance that 55 billion lira chunk coming due and on decent terms?
That will be the key financial metric to watch in 2026. The operating performance is, frankly, heroic, but the financial environment they're operating in remains hostile.
And that hostile environment really shows up in those currency losses dragging down equity.
It does, which leads us to a final thought.
Okay, leave us with something to ponder.
We've seen Shishikam invest huge amounts, billions of lira equivalent, presumably, on complex hedging strategies to manage their foreign currency exposure.
Right, trying to protect themselves.
Yet, despite all that effort and expense, they still end up with nearly 72 billion lira in accumulated translation and hedging losses weighing down their equity.
So the question
Is it actually possible for a company with this kind of immense global reach, operating in so many different currencies, some highly volatile, to fully insulate itself from these massive macroeconomic financial pressures? Or are these huge FX management costs and accumulated losses simply the unavoidable price you pay for being a true global player today?
Hmm. Is it a cost of doing global business that you just have to accept?
It certainly seems that for Shishikam, the battle for shareholder value is being fought on two very different fronts. There's the factory floor and the supply chain, where they seem to be winning spectacularly right now,
And the second front.
the global financial markets. And there, the forces at play are arguably far larger and more unpredictable than any single company, no matter how well managed, can ever fully control.
A fascinating and perhaps sobering thought to end on. Great analysis.
Always interesting to dive into these numbers.
Thank you for joining us on this deep dive into Shishikem's Q3 performance. Remember, if you found this useful, please like, subscribe, and share it with others. We'll catch you on the next one.